Our next guest says that Ben Bernanke made the right call and that more quantitative easing could actually be on the way. Joining us now is Rich Clarida. He is Global Strategic Advisor for PIMCO, the world's biggest bond fund manager. And Rich, you saw the market action that we summed up for everyone earlier. Investors had already been front-running the Fed in the weeks before this quantitative easing 2 announcement. How much more upside is there left in markets? And if that's the case, would the Fed really need to embark on a second round or third round of quantitative easing?
Well, I think what the Fed indicated is both the size of the package, $600 billion, and really concentrated on what the traders call the belly of the curve. So you saw some interesting price action with the 5-year yield falling, the 10-year yield actually going up. A bit of a disappointment about those composition effects.
And the 30-year.
And on the 30-year, of course, selling off because of first, they're not going to be buying a lot of 30 years, and secondly, potentially, inflation really will hit the 30-year bond. So my take on QE2 is that this is the next step. I don't think the Fed rules out, just as in the QE1, they did 2 installments of it. There could be another installment. They said in their statement they're going to monitor the data carefully. They have a dual mandate, unemployment and inflation. And so certainly I think this is potentially not the end of QE, depending on the data.
The thing with QE1, though, was it came when economies around the world were mired in deep recession. This time around, there is growth.
Right.
It's not great growth, but there is growth. What would have to happen next time around for the Fed to then embark on more easing? Have the standards slipped?
I think that the Fed has indicated very clearly it has a dual mandate, inflation of 2% and a low unemployment rate. And right now, the Fed is falling short on both of those mandates. And so I think this indicates the Fed takes that dual mandate seriously. I would say if a year from now, if unemployment is 9.5, certainly 10%, we're going to see more. It may take a different form. It may be concentrated in different assets. But essentially, the Fed can't cut interest rates. They're at zero at the short end. So they have, if they're going to ease policy, they have to do it through these quantitative measures.
Right. Jobless claims this morning you saw were pretty disappointing, staying above 400,000. When will we start to see that trickle-down effect between what the Fed is doing and the unemployment rate coming off a bit?
An excellent question, and I wish I had an answer, but that's a great uncertainty. That is, the transmission mechanism from lower rates to more economic growth is an uncertain one, and right now it's not operating that the Fed would like. And most economists would have thought with these low interest rates and the quantitative easing we've had, we would have seen more of an impact on job growth and the economy, and we haven't seen it. So I think there are concerns in Washington about the transmission mechanism.
Today we got a contrast between what the Fed is doing and what's happening in Europe. The Bank of England and the European Central Bank declining to follow the Fed's lead in pursuing more easing measures. Is quantitative easing, this idea of buying bonds on a large scale, something only the world's reserve currency, the owner of the world's reserve currency, can afford to do right now?
Well, right now, and that's the key point. 2 years ago, the Bank of England and to some extent the ECB was doing quantitative easing in the crisis. But right now, the U.S. is the only major player doing some version of QE. And I think the reserve currency status of the dollar is a factor that would allow that, in the sense that quantitative easing will lead to a weaker dollar. We're seeing that. And many other countries, if they tried to try this on this scale, might be concerned about a collapse in their currency. And I think Bernanke's making the judgment that this will lead to an orderly decline in the dollar, but not a cataclysmic decline.
Does the fact that the Fed is going at it alone ensure or increase its chances of success then?
Well, certainly in the sense that if the Bank of England and the ECB and Asian central banks were also doing some version of QE, that would tend to neutralize the effect on the dollar. Currency values are relative price propositions, so that's why this really impacts the dollar.
Okay, Rich, you oversee coverage of PIMCO's central bank and sovereign wealth fund clients. What have your clients been saying since the Fed's announcement yesterday? Are they surprised by anything? Are they disappointed by anything? What was the most interesting thing you heard from them?
Well, it reinforces a theme that I've been picking up for some time now, whereas many of these investors have really long-term horizons, 3 to 5 years, and many of them have been concerned about upside risks to inflation. A lot of them actually pursue investments in inflation-indexed bonds, for example. And so this, if anything, reinforced the wisdom of that.
Now, your colleague Bill Gross has slammed quantitative easing in his monthly note, calling it inflationary and Ponzi scheme-like. How does that how do you reconcile that with the idea that perhaps the Fed might need to pursue more quantitative easing going forward?
Well, I think that the point is that right now the Fed is the only game in town. I think the textbook would say right now that where the U.S. economy would really require a fiscal stimulus appropriately designed, but that's really not in the offing now with the election. So the Fed's the only game in town. I think it's understandable that it's pursuing a version of quantitative easing, but we're clearly in a world of what economists call the second or third best.
Now, obviously, the warnings of QE2 are many-fold. Bill Gross, for instance, talking about inflation, asset bubbles, liquidity trap among them.
Yeah.
You call QE2 a risk management exercise. Can you explain that a little bit?
Well, I'm now interpreting, I think, the Fed's motive. The Fed sees it as a risk management exercise.
Okay.
In the sense that the Fed is much more concerned about a deflationary outcome of falling prices than it is about a rise in inflation, potentially above 2% 3 or 4 years from now. And so from the Fed's point of view, with a dual mandate, 9.5% unemployment, inflation well below its target, the Fed views this right now as a pretty straightforward call. Do quantitative easing. It will clearly lower rates. It'll weaken the dollar. It'll support equity values, narrow credit spreads, and the Fed is hoping that that leads to economic growth, lower unemployment. That's the transmission mechanism that they can't directly control.
Over what period of time will we start to see the benefits?
Well, certainly, the Fed is hoping to see those benefits in 2011. There's
First
an old
half,
saying,
second half?
There's an old saying, monetary policy operates with long and variable lags, and they're hoping this time it will be neither long nor variable. But the truth is, we really don't know.
Okay. Now, when will we know the answer to the commodity price increase here? Because commodity prices have been rising, the CRB index around about a 2-year high. We're looking at gold rally every day when the dollar falls. The Fed says inflation is not an issue, and deflation, if anything, as you were mentioning, could be a greater risk. When is that going to start being something that the Fed has to respond to?
Excellent question. And I think the short answer is that the Fed tends to focus on a core measure of inflation, and it tends to also focus on labor cost.
And that's to smooth out the volatility.
And that's to smooth out the volatility. And so right now you do see this divergence between these core measures, which are low and not rising, and these more market-sensitive measures like commodity prices, break-even inflation, which is moving up. But your point's very good. If we go for some time, let's say well into 2011, with continued escalation and break-even inflation and this movement in commodities, there will be people at the Fed who will start to take notice of that.
Okay, not just Honig.
Perhaps more.
All right. Yeah. Thank you so much. Rich Clarida of PIMCO, the Global Strategic Advisor of the Bond Fund, talking to us.